Hello. In today's video, I'm going to talk about a recent update to the MACD module. Now I have it on the chart here on a particular coin that I'm going to look at. So let's get right into and actually describe what is going on. First, let's zoom this in. Now we have the MACD by itself. The red line being the MACD moving average, the blue line being the signal line. The green line is a histogram or the delta. You could set it either way. I prefer the line, but if you would prefer a histogram, you can go to Styles and pick histogram. For me, I prefer the line for what I look for when I trade. But either way, it works perfect in terms of what you want it to do. So we'll leave it like this for now. And let's get into what we're looking at. The improvements within the algorithm give better signals, meaning you can see more visually the accuracy of your signals, and you can also now filter weak signals out. As you can see on the chart, the 0 point. This is where the crossovers take place. With the new features built into the Jackrabbit MACD module, you can now filter out signals that take place too close to the 0 line. Using the scale at the right, you can actually see the deviation between the moving averages and the 0 line. And this gives you a way of actually tracking and eliminating signals that don't give you a good quality. So let's start with the basic settings. Let's go to historic markets. And everything is pretty much standard from the previous version. Now I'm running just a standard EMA 12.26.9 for all of the settings. Nothing special here. You can go with my favorites, which is to use prime numbers like 11.23.7 or 13.31, 11, so forth. That's up to the asset and your own personal choices. But now we get to the additional part. Minimum buying distance from 0 line. That is, how far away can the crossover be from the 0 line in order for you to actually get the buy signal. So let's actually move this over some and start tinkering with some numbers. So it looks like a crossover before 10 p.m. took place at 0.2 below the signal line. So let's set, don't know why that does it. Let's set the actual buy distance at 0.1 now. Let's see how it affects it. Okay, did we see any visual difference? Well, yes, all of the left-hand side disappeared. So all of these on the left-hand side got filtered out because they were below this minimum threshold. Okay, so now let's see if we can keep going. And we just got rid of 2 on the right side. So now we have eliminated some of the weaker purchase signals. Now let's see if we can do the same thing with these selling numbers. Okay, sell deviation looks to be as high as 0.3. So let's cut that in half and see what we can eliminate. Okay, we've actually gotten rid of all of the weak signals, and now we are left with only strong signals. So as you can see, the new filtering system really hones in what you are looking at. And you can see a lot of crossovers that just don't meet the grade. Now this means better profitability by getting rid of weaker signals. So it's something to bear in mind as you are working with MACD, looking for the perfect entry and the perfect exits. Because sometimes you just right at that fine line where you have the perfect place to get into the market, but then you have a lot of noise afterwards or before. This really brings that into tune. So now that we have the basics down, let's get into an actual high yield, very profitable recipe. And this recipe is proven to be quite resilient, even in a downtrending market. So we're going to go through all of the components of this recipe and just how MACD plays a role in that. It actually plays the most important role. So here we are. Here is the full recipe. We're using momentum, MACD, and Parabolic Sar to find entry points, and we're using the dollar cost averaging module to find exit points. Now you can sell by strategy, and this does do very well. But for my intended purposes, I strictly want upwards markets only at quick scalps. My goal for this is to try to get an average of 1% per day that I can compound. Now, as you can see from this current number of trade cycles, on a 1 minute chart, which is roughly every 4 days, you have 10 trades. So basically you are doing 2 trades a day, 1% profit on average each trade, easily making the mark that I want over the course of a 30-day period average. So in essence, whatever your position size is, you are going to gain a 30% return of investment over the course of a month using this approach on a 1 minute candle. Now, I emphasize average. Some days aren't going to be all that great. Some days are going to be accumulations that stack up. But that is the beauty about this improvement. The stack ups or the accumulations can be tuned only to get the best possible opportunities. So let's start at the bottom of the chart. This is a classic momentum. You purchase when the price is above the momentum line. You sell when the price is below the momentum line. This keeps you from purchasing in downtrending markets. Now, of course, if you make a purchase and the market goes against you, that's a whole different story. But that means that the next time the market levels out and starts with a small uptrend, another opportunity will present itself to get into a good position. And I'll demonstrate that in a moment. Okay. Here we have the Parabolic Sar. We're using it as a confirmation filter, just to make sure that we get only the best opportunities. As you can see right here, we have two sell signals, but the Parabolic Sar confirmed that this sell signal was the best one for the opportunity. So now let's get into the MACD itself. Here we are, just the MACD. And you'll see we have quite a range on this asset. We have 100 points above the zero line and roughly 150 points below the zero line. So we are taking on quite a few trades that are not necessarily the best quality. So we want to be able to really hone that down. Let's start by bringing the chart into focus a little clearer so we can get the scales. Okay, here we're looking at the 20 to 40 range for purchases and the crossovers at the 20 range, 15 to 25. Okay, here we go. Crossovers at the 30 range. So that's a good quality there. Okay, let's see if we can find good quality entries. Now, some crossovers just don't rank. So you have to understand, as you observe, that the algorithm filters out what is considered bad trades. In this case, in looking at the delta or the histogram, you see it's above zero. So that's suggesting that the market's not in a stable state. A good purchase will put the delta below zero with the moving averages. As we see here, the delta is below zero. That is important. We want the best opportunity possible. So we want to filter out any trade that isn't a good trade. So let's see. Still not getting very good entries. As you can see, the market is quite weak in a lot of areas. But it looks like if we do a purchase distance of 20 and a selling distance of 25, we can filter out some of this noise. So let's see. Let's actually bring up our settings. Let's slide this over. Okay, minimum distance. Now when we pick our numbers, the scale on the right side is the critical part. This tells you the range we need to focus on. Okay, we've actually gone through and eliminated quite a few weaker signals. So let's see if we can get this down a little bit better. And just by using the up and down arrow on the field, you can slowly filter out signals that don't meet a certain criteria. Okay. So we have a MACD distance of the crossover from the zero line of 25. And that has given us really some pretty good entry points. So let's see about our selling. Okay, we're going to set our selling to 25 just to make it easy to figure out. All right, everything disappeared except for one signal. That might be a little too repressive. So let's drop it down a little and see what happens. Okay. There we go. So a selling of 20 and a buying of 25. That's a pretty good range, and it looks like it's going to produce some very good results. Of course, we can always come back and check it. So there we are. We see the MACD purchased. So let's see if we can find a completed trade cycle. Let's enlarge this. So by spending a little bit of time with that filter, we got a pretty good entry and a pretty good exit. Very little drawdown, very little below the average blue line of the dollar cost averaging, and it hit the take profit fairly easily. So in terms of what we're doing, this looks to be quite good. So let's bring this, the dollar cost averaging, up by itself. Okay, let's go to the end of the chart. So here we have a fairly good representative of the changes we've made. 3 completed trade cycles with an average profit of 1.4%. Last profit brought in 1.2%. Now for this coin, this became a one-hit wonder. 1 position per cycle, maximum 1 position per cycle. So over the last 4 days, it's made roughly 3% profit. And it's only done so 1 position at a time. That's excellent in terms of risk management, risk mitigation. So Cryptohopper, 3 commas, Jackrabbit Relay, Alertron, whatever you want to use to send your signal. You could easily set this up with 50 coins, only allowing the top 5 or the most volatile 5 to trade at one time and have a consistent amount of income on a daily basis. This could potentially be exactly what you want. The benefit of this is very simple. If you do get stuck in one coin that might have a longer run, because you have 2 or 4 or 5 coins trading, those other coins are going to be making up the difference for your daily income. So if your target is 1% per day on average, this will achieve it. Now, if you use compounding, you could easily bring in $200 to $300 a month, realistically. And that's easy to figure out. Look at your position size. If your position size is $100, At one position, you're looking at $1 profit per trade. Within a 3 to 4 day range, this one coin is going to make $3 of profit. Within a 30-day period, this one coin is going to make $30 in profit, because there's 10 periods of 3 to make 30 days. So $10 by 5 coins, you've made $50 rough average in 1 month with very little effort and a very highly resilient approach. Now, of course, your position size is everything. The more you can afford for your position size for this kind of an approach, the better your outcome will be, particularly if you just simply let it compound over time. So let's take a look at some of the trades that this made. Okay, we've already seen this trade. Quick, short, and simple. Okay, and here are the other 2 trades. Also quick, short, and simple. So let's actually see what this looks like with other coins. Okay, this coin needs to be adjusted because the range of the MACD isn't the same on this coin as it was on the other. So that's something to be aware of when you're working with the filtering system. It's not a one-stop shop all approach. You have to tune it for each and every coin, particularly to your own personal risks. For now, I'm going to set both to 0, meaning it can be any distance from the 0 line. And as you can see, there's a lot of noise. But let's see how this recipe handles that noise. Providing I can get the chart blown up. There we go. So 10 trades within the last 3 days. Now it did take on accumulation, the average of 2 positions, the highest of 4 positions. That's not a bad thing. You just need to be aware of it. 10 trades in a 3-day period is good. You're looking at 10 trades, 2 positions each. So if your trades are 2 positions, $100, that's $200 budget per trade with a maximum of $400 for your worst case scenario. Now you do need to plan for higher, but still 1% of $400 in that one trade, you've made your 1% per day average. Compounding will take this and actually build on it quite nicely. Let's take a look at this trade. Some spots that do have a drawdown more than what I like, but still, because it's a dollar cost averaging approach, it's reasonably safe with a proper budget and risk assessment. You only take a loss if and only if you sell. If you don't sell and you have a good quality asset above 1 billion market cap, you can sit and let this recover. Now, if you have 5 coins trading at once, then this isn't going to be a problem because you're capitalizing on market volatility. So the next coin in line that's going to be slightly more volatile is going to be traded and profited. So it is an aggregated effect that capitalizes on the updates that MACD is now capable of. And you can sit here and take a few seconds to tune MACD, particular for this coin, and eliminate some of the noisier areas that you may not want. The reality of it is this update really brings home a whole new level of power, filtering, and analysis in the MACD that didn't exist previously. It also doesn't exist in any other framework in trading. So you have a very good filtering system now to really hone in and really take advantage of some very good opportunities. And as you can see, these opportunities are quite good. Here we actually have an accumulation cycle. You see it, it's counted for, you can predict it, and you still did well in the end. Now this one has a rather steep drawdown, but notice it didn't purchase here. This big drop. A lot of algorithms would purchase here. This one didn't. But this is an accumulation, so it did purchase here. Notice the distance between the position previous and this position. The best opportunities only. So this doesn't waste your money on opportunities that aren't truly there. The new and improved approach really filters out the noise, even without the additional filtering layer to get rid of the weaker signals. So, as you can see, simple, easy, elegant, and profitable. Okay, let's go on to the next coin. Now, many of these coins are difficult coins. They have a difficult history, and they can be problematic to trade in the long term. But they're still profitable now. 8 trades within the last 3.5 days. 1% average. All you need is an average of 1% per day to do well in the market overall. You hear 1 3-day period, worst case 4 days, you've made 8 trades. You've met and exceeded the 1% per day average. You do this 10 times a month, you've brought in a significant bonus to your account. Now, of course, proper planning, preparation, risk assessment, and risk mitigation are all critical. Ethereum, 14 trades, and the level of positions for these 14 trades is outstandingly low, especially given the market we've been dealing with. This is very good trading. And tuning this would be remarkable all the way around. 15 trades. And look at your maximum. 2 positions over the last 4 days. 15 trades. This is another good coin with exceptional opportunities. $20 trade cycles for LTC. Also minimal risk. Here we have a trade on the screen. Short, simple, complete. well worth looking into, investigating, and researching. Neo, 13 trades, not bad, and well, really pretty good. Tron, the coin that just doesn't want to go anywhere quickly. And yet it made 8 trades. So if you're looking for a low-risk coin, this is really it. It's one of the best low-risk coins on the market. You can trade very minimal amounts and really take advantage of testing this system with Tron. $12 trades. And even with this coin being difficult to manage, the average positions and max positions are very low. Another exceptional coin. Remember, all of this is driven by MACD. Entry points are spectacular. Low risk. Good entry, high trade. 12 positions. MACD is one of my favorites as well. I talk about Bollinger Bands a lot, but in terms of diversity and capabilities, MACD is probably the one indicator that offers the most ways of using it. And here we have an asset that has had a jaded history, 9 trades. It has a higher than normal accumulation rate of 3 positions. So really, even with a difficult coin, this is just amazing. And here is another coin that is really not that long on the market, but has done well with its market cap value. 17 trades. So it's important to understand and realize, even though that this is a look at the last 3.5 days, it gives you a fairly good idea of what this does over the next 3 days. But now let's go back and actually get back to Bitcoin, and let's take a look at it through one of the roughest bear markets we have had in a long time. There's no question, this is a money-making train with the right budget, the right preparation, and careful analysis of what you're trading. Every one of these coins, spectacular. So here we are back on Bitcoin. The coin that literally lost 2/3 of its value from a high of $65,000. How does this do in the long term? Let's find out. Okay, let's go to the 3-minute time frame. Average 1 position, maximum 2 positions. Five-minute. Well, this is a pretty good gold mine. 1 position, 2 positions between the average and the maximum for 77 days. 7-minute. Okay, the 7-minute trade cycle took on some accumulation. 16 positions though, and it's in the deepest of that trade cycle. So that would be expected and realistic. But it's still a very good approach. When you figure 101 days, 16 positions in that short or that long of a time frame really isn't that bad. That's reasonable. And the profitability of 16 positions at $10, 1% of 16 is 16 cents. Now 16 times 16 and you get your reasonably probably about $1.72 on a $10 position. But you're obviously not going to use $10 if you're waiting 101 days, unless you're using aggregation on different time frames, in which case you have an open field of opportunities that could really drive this whole mechanism quite nicely. Let's go to the 13-minute. Well, 13-minute is just as good as the rest of them. The ever classic 15-minute. It's doing good too. $17-minute, maximum buys of 10 positions. That's not bad. 8 trade cycles. So even when you look for unusual and strange markets, markets that normally wouldn't do well, this is doing well. And it is quite capable of sustaining larger positions. "57 minutes, almost 1 hour, 12 positions. Let's see if 3 minutes actually makes a difference. Not really, but less profit, 4%. That's definitely worth keeping. As you can see, every single time frame shows relatively low position sizes. This is a clear approach that's defensive yet aggressive. It does very well, has opportunities to be able to filter out even weaker signals, and can really capitalize on a strong market. So if you're not using MACD, or particularly if you're not using Jackrabbit's MACD, you're not really getting the best that MACD can offer. The moving average convergence divergence is one of the best indicators in the market. The Jackrabbit version is just that much more over the top. So if you like this video, subscribe. If you want to use the Jackrabbit version, sign up to my Patreon, the Jackrabbit tier. Get access to these kind of pre-made charts where all you have to do is place your signals and go to town. Let it trade for you. Any REST API system that supports TradingView will work. There are dozens of approaches that you can use with MACD that are money-making. With proper risk, proper budget, and proper research, you can't go wrong with this versatile indicator. Until next time.